Hi, this is Sharif Abdou. I'm a senior analyst here at ValueLine. Let me go ahead and share my screen. There we go. Hopefully you can all see that clearly. I'm a senior analyst here at ValueLine, and everybody here at ValueLine hope that you and your family are staying safe and dealing with these trying times as best as possible. So before I jump into the heart of the presentation, for those of you who are joining us perhaps for the first time, I want to provide just a brief overview of who we are at ValueLine. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Many of you may be familiar with our flagship product, the ValueLine Investment Survey, but we also have other more premium services such as the ValueLine Dividend Income and Growth, the ValueLine ETF service, as well as the subject of today's presentation, which is the ValueLine Select. ValueLine Select, by the way, is our premier service. Reports in the ValueLine Investment Survey provide a concise one-page overview of a company's operating results, their financial position, and our forward-looking projections. Just to contrast that, ValueLine Select actually provides a more detailed, more in-depth analysis of one particular company that we believe is worthy of highlighting for that month. So we tell you what stock to buy and when to buy it. We also tell you when it's best to hold the stock and simply maintain your position, neither buying nor selling. But I think the most important part, the key to the service, is what sets the ValueLine Select apart from competing services from other providers. We also tell you when to sell, okay? Whether that's to maximize your returns or to exit a position that we believe no longer has superior prospects. So I'll give you a few recent examples of ValueLine Select buy recommendations. That includes Dollar Tree, which operates a vast network of discount stores. Dollar Tree entered the Select portfolio in September of 2021. Okay, subscribers that followed our guidance would have realized a return of 82.7% during that holding period. So from September of 2021 till now, roughly 83% return. Okay, another example, software maker Adobe. Okay, we all know Adobe. They make, the Adobe PDF reader. They make Lightroom, which is photo editing software, yada, yada. Adobe entered the Select portfolio in October of 2019. Okay, so roughly about 2.5 years ago. Readers that followed our recommendation to buy Adobe would have realized a return of roughly 71% during that holding period. Okay. One other recommendation that we made is Alphabet, better known as the parent company of Google. It entered the Select portfolio in July of 2019. Subscribers that followed our guidance to purchase Alphabet in July of 2019 would have realized a return of 124.7%. Okay, so really nearly a 125% return on Alphabet during that holding period, roughly 3 years, July of 2019 till now, roughly 3 years. So if you have any questions about the products or services that we offer, any of the products that I will discuss today, or our different tiers of subscriptions, that information can be found at valueline.com, or you can always call 1-800-VALUE-LINE, spelled exactly how it sounds, 1-800-VALUE-LINE. Please note that this presentation will be available on our website, and that's www.valueline.com, as well as on our YouTube channel within the next 48 hours, okay? Okay, that's enough tooting our own horn, so let's have a brief discussion about the current economic environment. The following content was prepared by our senior economic staff, and I'll quote. The U.S. economy remains in relatively good shape, as highlighted by the May employment report. According to the Labor Department, 390,000 non-farm payroll jobs were added last month, which was lower than the April tally, but stronger than the consensus forecast. That headline unemployment rate held steady at 3.6%. The jobs report also showed hourly earnings rose 5.2% year over year. That, along with other elevated measures of inflation, should justify further monetary tightening by the Federal Reserve. The next decision, a likely half-point hike to the benchmark short-term interest rate at this month's Federal Open Market Committee meeting, was scheduled to take place shortly after this current presentation goes to press. So going forward, the central bank will have a challenge in seeking to contain inflation without pushing the economy into a recession. Ooh. Meanwhile, the corporate profit outlook will be closely watched by Wall Street. In a few weeks, the second quarter will draw to a close, and for the most part, earnings are expected to advance at a modest pace. However, major companies' predictions will be out of the utmost importance. Of note, we have already received some negative commentary from a handful of prominent CEOs suggesting that employee cutbacks and other defensive measures are on the horizon. The stock market remains quite volatile. As May closed, the broader averages, though, did manage to stage a constructive rally, possibly signaling that the market might be stabilizing. It is probably too early to know if the latest rally was merely some bargain hunting or if a sustained leg up will develop. Clearly, it would be encouraging to see broader sector participation and investors returning to the leading technology issues. In conclusion, while equity valuations recently at a tad below 17 times 12-month forward-looking earnings seem reasonable, and pockets of speculative excess have clearly dissolved, bears would advise not to fight the Fed, namely the central bank's tightening of liquidity. In the current environment, investors hardly need to flee equities headlong, but would do well to keep a good stockpile of cash in reserve pending a solid bottom. For those with long-term time horizons, there are and will be good opportunities available. However, volatility ought to be expected. Close quote. So we went over the current economic picture just a little bit. Now I'm going to walk you through the process, the selection process for the latest stock to join the Value Line Select portfolio, which was Costco Wholesale, by the way. That report left the press earlier this month. Okay, so I'm going to give you a little intro to the screener. Okay, I'm going to show you how to access it. As you can see right now, I am on the Value Line homepage. This is the dashboard. This is kind of like the main landing page for subscribers. Here you're going to find, economic commentary such as this here. We have daily market updates. We have supplementary reports, which you can see here. We have, it's a plethora of different content, and it's always up to date. There's new content always being rolled out every day. From there, since we are specifically looking at the screener today, so you'll see here, I'm at the top header here, the top bar. We're at the dashboard. We're going to slide on over to find ideas, okay? From there, we're going to go to the subheader, and we're going to choose screener. Hopefully that was clear enough for everyone to see. Now, one thing I want to touch on is for Value Line Select, the screener is just one element of our selection process. This first step helps us sift through the thousands of equities that are in our database. Okay, we're using targeted, relevant criteria. Anyone can randomly select different screening criteria and come up with a list of stocks, right? There's not much to that. You might as well just throw, darts at a dartboard. What separates Value Line Select is that this is a curated process. Okay, we're starting with specific complementary criteria that meet our requirements and taking everything into account, right? The current market environment, the current economic environment, and other factors to consider. So, in light of recent events, right, the current market volatility, the higher than normal inflation, concerns about the economy, the war in Ukraine, persistent supply chain bottlenecks, we want to start from a position of we're going to be a little bit conservative to start out. Okay, let me put it that way. So the first thing we did for this screening process is we chose the country of domicile, and we chose for it to be the United States, and only the United States, okay? Doesn't eliminate all our risk, obviously, but we feel that, given the higher volatility that has been exhibited overseas, we felt a little bit better about choosing a company that is based in the U.S., okay? We want to cut a little bit of that risk out. Now, the next thing we looked at is market cap, okay? these first three criteria that I'm going to present right now: country of domicile, market cap, and then the next one. Let's just think of this as like a baseline, right? We're not getting deep into the selection or the screening criteria yet. This is just the baseline. We want the country of domicile to be the U.S. Let's choose a market cap, a minimum of 1 billion, okay? And we're going to filter that down. So we started out with, 5,700 stocks that are in the Value Line database, and we've already got it down to just under 2,000, okay? So the next layer that I'm going to add right now, this is just our first layer. This is what we're going to add. We're going to go down here to ranks and ratings, and we're going to add safety. This is one of my favorites, okay? One of my favorite screening criteria. And we're going to start with a safety of 1 or 2, right? The safety rank, allow me to do a little interlude here. Safety rank, financial strength, market cap, beta coefficient, timeliness, technical ranks, et cetera, et cetera. For anyone who's not familiar with our different metrics and different criteria that we use, you can find all of that right here, under investment education. Okay, so let's go ahead and just take a peek over there. I'm just going to quickly show you where you can find that. So this is investment education. Here you're going to find a wealth of information. You're going to find instructional videos, you're going to find investment guides, and right here, we're going to find the glossary. So let's click on that, just quickly take a look. Okay. And here you can see, it's everything you can think of. It's every kind of term. If you've ever read a term in a report and you're scratching your head a little bit, every term you can think of, we have it here, and it's been clearly defined. It's in a way that, it's bite-sized. You can understand what it is. We try to cut through a little bit of the jargon and make it, approachable. So we're going to take a quick look at safety, since I just mentioned the safety rank. I'm going to make that a little bigger. So you'll see that the safety rank is a measure of relative potential risk associated with individual common stocks. The safety rank is computed by averaging 2 other Value Line indexes. That would be the Price Stability Index and the Financial Strength Rating. Safety rank is arranged on a pretty simple scale from 1 to 5, 1 being the highest, 5 being the lowest. So generally speaking, conservative investors or more conservative investors should try to limit their purchases to equities that are ranked 1 being the highest, or 2, right, above average for safety. All right. Now let's pop back into the screener. We started with the country of domicile, the United States. We started with the market cap above 1 billion. We started with the safety rank of 1 or 2. Now, in light of recent events, like I just said, we wanted to add more defensive characteristics to our initial screening process, right? Not just defensive, but you could almost say counter-cyclical characteristics, okay? So what are we going to choose? We're going to go down here and we're going to take a look at financial strength. Okay, and we want financial strength of A+ or A++. So basically, these are your blue chips. These are companies that we feel have the most robust balance sheets, the most robust financial positions. They have ample cash on hand. They have very low debt to total capital ratios. They have ample interest coverage. So these are the companies that we feel are, again, in light of recent events, we want companies that are a little bit more robust, a little bit more secure. So the next thing we're going to look at, we're going to apply another kind of defensive, kind of counter-cyclical characteristic. We're going to look at the beta coefficient. Now, for those of you who don't know, the beta coefficient, it's a relative measure of historical sensitivity of the stock's price to overall fluctuations in the New York Stock Exchange Composite Index. So, for example, okay, the market beta is considered 1.00. A stock with a beta of 1.5 would indicate that the stock tends to rise or fall 50% more than the New York Stock Exchange Composite Index. Okay, makes sense? It's intuitive if you think about it. So a beta of 1.5 would indicate that the stock would fluctuate about 50% more than the than the composite index as a whole. So what we're going to do here, we're going to make the beta, the market beta is 1, we're going to make it 0.8. Okay? We want something that's a little bit countercyclical, a little bit defensive. So the next criteria we're going to apply, and this is another one of my favorites, and this is time and shrinks, right? This is the tried and true value line metric, and we're going to look at stocks with a time and rank of 1 or 2. Okay. The timeliness ranks, for those of you who are not familiar, it's the rank of a stock's probable relative market performance in the year ahead. Okay, it's derived from a proprietary computer program that uses several inputs. That includes long-term price and earnings history, recent price and earnings momentum, and earnings surprise. Okay, again, it's a scale that's kind of easy to understand. It's a scale of 1 to 5, 1 being the highest, 5 being the lowest. So stocks that are ranked 1 or 2 are likely to outperform the market in the year ahead. Stocks that are ranked 4 or 5 underperform the market in the year ahead. You know, it's intuitive. Now we're going to apply one final screening criteria, and we're going to look at 18-month TPR. So similar to our 3 to 5 year target price range, 18-month TPR, it was rolled out by Value Line. This is a relatively new innovation where we have the 18-month TPR. So that is what we feel is the target price range for that particular stock in the coming 18 months. Instead of looking out 3 to 5 years, we're looking at the next 18 months. So we want a TPR appreciation. We want the minimum to be about 25%. Okay. And so we started with 5,700. We're now down to 9. So you can see that the screening criteria really kind of sifts through a lot of the, you know, we were trying to separate the wheat from the chaff here. And right now we have 9 companies, and you can make a pretty solid argument for any of these 9. We have Adobe, we have Amazon, Comcast, Costco, Intel, Oracle, Pfizer, Regeneron, Tyler Technologies. These are all, you know, pretty well-known companies, well-capitalized, solid financial strength ratings, solid safety ratings. They're sizable companies. They have a competitive advantage in their respective markets, right? This is when the second part of the screening criteria, this is when you get the human element, okay? We're applying the sort of computational part by using the screener. We've got it down to the final 9. This is when I'm going to put it in air quotes, the spirited discussion begins. Let's just say it was a lively debate, okay? People have strong opinions, and that's a good thing, right? We don't want groupthink, we want varying opinions. So after discussing this with some of our senior analysts, our economic staff, our statisticians, after discussing it, we went through this list of finalists, and we decided that Costco would be the next stock to enter the Value Line selection portfolio, and it did earlier this month. Now, about the screener, just a quick note. Subscribers have access to 15 preset screens. I'll show you up here quickly. See these presets here? And it's all kinds of different interesting combinations. Small cap stocks with above average yields, stocks ranked 1 for relative price performance. It's sort of a preset, you know, it's combining different criteria for you, and they're bundled together to kind of yield results in a way that's less fiddly, you know, for people who are maybe a little bit new to this type of thing, that's less fiddly, and it gives you a good starting point at the very least. So one of my favorite presets is actually timely stocks and timely industries. I use this one all the time. But we're not using a preset today. I just wanted to touch on that. I should also mention that we have another 100 or so fields are available, but it requires a higher level of subscription. If that would interest you, please call 1-800-ValueLine.com. That's 1-800-ValueLine.com. Also note, before we jump ahead to our selection, that you can Screens can be saved and revisited by utilizing the Create Saved screen. You would click here, and you can name it whatever you want. You can name it June 30th, excuse my typing, June 30th conservative screener. Did I actually type that correctly? Ooh, conservative. Okay, there we go. Conservative screener. And then you would click save. And you can come back to that at any point. You can actually come back and modify the same screen. If you wanted to refine your screening criteria or move some of the factors up or down, you could do that. So just to let you know that you can save these screens for future reference. Okay. So we did select Costco. I'm going to go ahead and click on that. We did select Costco as the next stock to enter the Value Line Select portfolio. And this here is kind of like the landing page for Costco. This is what we call this our digital report. Excuse me. And here you'll see sort of a brief overview of all the different criteria or different metrics for the company. Last price, the trailing PE ratio, relative PE ratio, the current dividend yield, our 3 to 5 year target price range, and then we have here our 18-month target price range. That's one of our criteria for today. See the safety, the time limits, financial strength. It'll give you a brief overview of recent financial results. This is our digital report. Now, if you wanted, you can also take a look at right here, near the top right of the page, PDF reports. And this will take you to our most recent full-page reports for Costco or for whatever company you may be interested in taking a look at that day. Okay, let me just give it to you a little bit larger, and you can see that we have the price chart, we have our statistical array, we have some basic information here, capital structure, current position, we have some commentary, and then we have the quarterly earnings and quarterly revenues, etc. This is a concise one-page report, right? This is giving you a snapshot, and it's something bite-sized. You can read it quickly. It gives you a good starting point if you're trying to make an investment decision. But for us today, we're going to look at the most recent Value Line Select report, which happened to cover Costco. So let's take a look. And I have that open. So here we have the Value Line Select. This report went to press earlier this month. And I'm just going to quickly give you a scan of it. This is not to toot my own horn, because myself and my associate, Mr. Nathaniel Aikman, we created this report. This report goes to press every month. This is a very in-depth report. It's very detailed. There is a plethora of information here. This is where we really get down into the nitty-gritty. The one-page reports are great. Like I said, as a bite-sized, good starting point. This is when you want to really dive into the company and find out a little bit more about it. So we see here that Costco, I'm sure you're all familiar, Costco Wholesale operates wholesale membership warehouses and e-commerce websites offering a limited selection of products at discounted prices. The company buys most of its merchandise from manufacturers, eschewing middlemen in the process, and it often routes those goods directly to its warehouse facilities. Fiscal 2021, I'm just going to highlight this paragraph here. Fiscal 2021 was a standout year for Costco, with revenues and earnings advancing 17.5% and 26.6% to company records of $196 billion and $11.09 per share. So I'm just going to take a quick peek down here, and we'll see that we expect fiscal 2022 to be another productive campaign for the company. Although revenues and earnings per share are liable to expand at a slightly more modest pace compared with last year's stellar results. You can also see here that based on the recent stock price and applying earnings per share and for 2021 and our forward-looking earnings for 2022, we see that the current PE ratio, let's look at 2022 specifically. I think 2021 was a little bit inflated by the market run-up. So we see that right now our forward-looking estimates for 2022, it's trading at a PE of about 37% as of the date of this report, which was earlier this month. That's roughly in line with the company's historical average and what our projections are 3 to 5 years out. So we think that the stock is pretty fairly valued. Not a bargain, but not overpriced either. We think it's pretty fairly valued. Costco shares rank highly on several proprietary value line metrics, especially those measures that emphasize stability, financial health, and near-term price momentum. That, in a nutshell, is why we kind of landed on Costco as our next selection. It's always a balancing act. It's always you're trying to balance between upside potential and risk, right? Between volatility and stability. You know, you want something that's maybe secure, but not so secure that it's a flat line. We'll see that here the company has a financial strength rating of A++ and a safety of 1. Both are our top ratings. The balance sheet is robust. It has a long track record of consistent operating results. It has a well below market beta coefficient of 0.6, which, you know, would indicate that the company has some defensive characteristics. It's kind of a counter-cyclical stock. And at the time that this report went to press earlier this month, the time of this rank was a 2, so above average, and it had a technical rank of 1, which is our highest. Just in general, we really felt that Costco would be a good addition to the portfolio. Our portfolio has become a little bit more tech-heavy. We have a number of companies like Adobe, we have Alphabet, we have Fiserv, we have a number of more technical or tech-related stocks. Datadog was a recent addition to our portfolio. So we wanted something that would act as kind of a ballast, right? We wanted something that would kind of even out the portfolio, right? We wanted something that's a little bit more brick and mortar, a little bit more conventional, something that's easy to understand and a little bit more stable, right? Their operating results tend not to vary too much. So we believe that Value Line Select recommends Costco Wholesale for a wide range of investors, and we believe a position here would be appropriate for most portfolios. Now, at this stage, I am going to take a few questions. Please note that I typically can't answer complex questions about specific stocks on the spot. First few questions were submitted prior to this presentation. Brian Green, thank you, Brian, for submitting a question. He asked, do you think it's a good time to buy Apple? Okay, Brian. Without getting too in-depth, I would say it's a fine time to buy Apple. You really can't go wrong buying really good companies, you know, that have a competitive advantage, robust balance sheet, top quality financial management team, I should say. Don't expect a bargain, okay? Right now, the market is fleeing to quality, so do not expect a bargain. But if you're taking more of a buy and hold strategy, I would say it's a fine time to buy Apple, but again, do not expect a bargain. Our next question was submitted by Mr. Abdul Aziz. Thank you, Abdul, for submitting a question. And this is the kind of the question that kind of gets to the crux of the moment right now and what's happening in the world and you know, the current market environment. Abdul was asking, in a highly fluctuating market, is it prudent to keep calm and not trade stocks? So my answer would be, I think that the crux of this question is, can we, whether we're individual investors or institutional investors, can we time the market? Is that something that we can do? I'm going to go ahead and spoiler alert. I'm going to tell you that, no, you cannot time the market. Can we sit out during periods of higher than normal volatility, then jump back in when some of that variability subsides? And for me, I go back to what Warren Buffett has said in the past. I'm sure most of you are aware, Warren Buffett, the CEO of Berkshire Hathaway, one of the most successful investors of all time. Okay, and I go back to what he says, and I'm paraphrasing here. He says some people don't have the mental or emotional temperament to be investors, right? It's not a matter of it's not a matter of intelligence. It's a matter of, do they have the mental or emotional temperament to be investors? And that's something that Mr. Buffett has often repeated, right? We have to be willing to withstand the uncertainty, or we risk missing out on the upside as well, right? The potential benefits. So I think the key is to have a well-diversified portfolio of good quality equities, right? Companies with solid business prospects, and preferably they're operating in a business or field that we as individuals can understand, right? If everything else about the company looks great on paper, but you can't wrap your head around what it is that they do, probably a good idea to pass. You know, you might be missing out, but it's just in general not a good idea to get into something where it's just, you know, it's another language to you. You know, really you want to be getting into something that you can wrap your head around. It's a business that you understand, and it's a good company with good prospects. So a well-diversified portfolio, good quality equities, solid business prospects, and preferably, you know, an industry or a field that we can understand. Let's take a look here. I'm going to see if we have any new questions popping up. All right. Let's take a look. Let's see. I don't see anything else at the moment right now. Nothing's jumping out at me. I'm going to go ahead and hand it off to Brandon. I'm going to thank you all for participating today. I hope that this was a good introductory presentation for those of you who are not familiar with Value Line Select and what it is that we do, and I think the value that we provide. And I hope to see you next time. Brandon, take it away.
Thanks everyone for attending today. This concludes today's event, and you may now disconnect your lines.